Welcome to a new podcast from the New Silk Roads. This time, Professor Richard Griffiths will investigate whether China trades more with BRI countries and why. It's a difficult puzzle and the results might surprise you. In any case, you will hear it in a bit. But first, check out our Facebook group where we have informed discussions and follow us on Twitter. You can also take a look at our website where we offer more podcasts, books, and a library dedicated to the New Silk Road.
At the start of this year, the official Chinese news agency celebrated booming trade with Belt and Road countries. Trade with Belt and Road countries had grown by 10.8% in 2019, compared with 7.4% for the world as a whole. Between 2014 and 2019, the volume of trade had grown at an average rate of 6.1%. And by 2019, China's share in the trade of BRI countries had approached 30%, 2 percentage points higher than in 2018. Considerable achievements, but note the way that the definitions shift from value in the first observation to volume in the second, and then on to world shares. And there's a second problem, especially if you take a longer time span. Does it include Belt and Road countries that are there at the beginning or there at the end? And anyway, there's the eternal question. What is a Belt and Road country? Is it a country that signed a memorandum of understanding with China? Or are they countries that haven't signed but are in one of the cooperative agreements that China deals with, like ASEAN or the 17+1 arrangements with Central East European countries? Does it include countries like India that were on the original list, but until May last year had not yet been removed? Okay, let's get back to the real question. Does China trade more with Belt and Road countries? The answer is yes, with some of them. But should we be surprised at this? I mean, after all, what sort of trade result do we expect with countries that are the object of such a large project? And if it's true, where should we be looking for an explanation? Well, I have to be honest, and let's put the conclusions up front so that if you prefer to switch off now and make a cup of tea or do something else useful, I don't know the answers. So what we're going to do now is to do a sort of finger exercise to see how close we might be able to get to tease out the solution to this riddle. Does China trade more with Belt and Road countries, and why does it trade with certain countries more than with others? Now, to find the answer, I'm going to use a concept called trade costs. Now, these were published first by the World Bank in 2016, and recently they've produced a second set of data that allows us to trace trade costs to 2017. So it captures the first 4 years of the Belt and Road Initiative. Now, what trade costs do is to try and calculate how much trade would you expect a country to have compared with how much trade does it actually have. And it does this by using an economic model. What it does is it calculates the amount of trade within a country. So if the two partners were actually in the same country trading with each other, but then it places those two partners abroad. So it means basically that costs are likely to rise, and as a result, the partner is going to buy less. And then it calculates the amount of this difference and expresses it as a sort of price differential that you'd need to explain the different result between foreign trade and domestic trade, and it calls that a tariff equivalent. Now, this higher price occurs for the transport costs to the border costs of leaving the country, the transport costs between the two countries and at any other transit countries it passes through, the border costs at the importing country, including any tariffs, and of course then the distribution and transport cost to the final customer. But note, none of these are measured individually. Now, the other thing that with these trade costs is that it measures the damage to trade in both directions, but it doesn't make any statement about which partner is responsible for the lower than expected trade. Now, trade costs are an elegant way of measuring a problem, and its methodology and its results are not really contested by economists. It doesn't mean that they're completely accurate. First of all, you have to make the assumption that the bilateral trade data sets are accurate, and that is far from being the case. And then you have to make the kind of assumption about what degree of price differential would produce that difference in trade. What sort of elasticity of demand would actually be necessary then? And that is a rather difficult calculation to make because we're dealing with a very heterogeneous set of products and we're trying to generalize one price effect that covers all of them and compare that with a different set of bilateral trading relationships. And it makes no real allowance for what you would expect in different sorts of product mixes. I said the produce is very diverse, but it's not equally diverse. For example, types of trade will depend whether you're a less developed country. If you're a less developed country, you'll probably buy a smaller range of industrial product than if you're a larger country. And it depends again by the size of a country. A small country will offer a smaller product range for exports. So let's go along with the exercise, but assume it's a sort of ballpark figure. Don't be too confident with the individual results between countries. But if there are large margins, there is, of course, likely to be some kind of effect that we're actually capturing. Now, the World Bank calculations offer trade cost data separately on manufactures, agricultural goods, and the total, which is agriculture and manufactures together. So it omits raw materials and energy altogether, and presumably because these are highly location specific, either you have it or you don't, and the prices tend to be very volatile. But these two considerations also apply to agriculture, with the added detail that that is usually where protectionism is highest. So what I'm going to do is to use the trade cost data for manufactures. After all, it covers about 70% of world trade by value, and it's the area where China has a dominant export position. And by the way, note that the level never goes down to zero. Take, for example, Austria and Germany, which have been in an economic union for 20, 30 years, where there is no difference in language, no difference in currency, under the same regulatory regime. And even then, there is a bilateral trade cost measured equivalent to a tariff of 20%. So now our question is, does China trade more in manufactured goods with Belt and Road countries between 2013, when the whole scheme is announced, and 2017, for which we have the most recent data? And I compiled the statistics for the original 64 Belt and Road countries announced and added to those all the rest of Western Europe. So we end up with a total of 80 countries. Not all of them had data, including rather embarrassingly the Netherlands, but almost all the countries are there. Out of those 80 countries, there are only 20 that show a measurable reduction in their trade costs. In other words, that trade significantly more with China. And I've put that level, the cutoff level, at above 5% increase, 5% decrease in the trade cost. Basically, there's a small group that are clustered between 15 countries between 5% and 1%, and the rest are broadly neutral, and some countries actually show an increase in trade costs. So you can see the top 20 countries in this graph. Between 20 and 30%, we have Latvia, the Czech Republic, Lithuania, and Cambodia. Trade costs falling between 10 and 20% in Georgia, Myanmar, Slovenia, Maldives, Montenegro, Switzerland, Afghanistan, and Albania, and between 5 and 10% in Kyrgyzstan, Sri Lanka, Lebanon, Philippines, Iran, Romania, and Croatia. The only West European country, the country that's not originally in the 64 Belt and Road countries in that list, is Switzerland. So look at it, I put it in a graph and I can see no real pattern in these results. And They certainly don't match the expectations that I had when I actually began the exercise. And I put them on a map for you, and to be perfectly honest, it doesn't really clarify matters. Okay, well, while I was working with the trade cost data, I thought, okay, let's try another exercise and we'll look at the 20 countries which have the lowest trade costs in manufactures in their bilateral trade with China. The logic was that it might be easier for China to expand its presence where there was already an easy trading relationship. Now, if you look at the map, you can see that these countries are clustered in Europe and in ASEAN, and Russia, Kyrgyzstan, India, Iran, UAE, and Saudi Arabia make up the rest of the list. Only three of those countries, Cambodia, Iran, and the Philippines, make it onto both lists. So basically, there's no solution there. The next thing I did was to look at countries that form the largest markets for Chinese manufacturers among that group of 80 countries in our selection. Could these results be the result of further market penetration in economies where China had already established a presence and a demand for Chinese manufactured goods? And again, I put the top 20 of these countries on a map of their own. If you notice, they tend to be the markets of larger and richer countries. There's again a large concentration in Western Europe and Southeast Asia. And countries which are larger, like Russia, Turkey, India, and Saudi Arabia, make up the rest. But then there's only one country that makes the top 20 in both lists, and that's the Philippines. So, not much luck there. Well, undeterred, I turned to another source. The Industrial and Commercial Bank of China publishes a China Connectivity Index, and it includes a trade score for 2013, which is the initial year for the Belt and Road Initiative. Basically, what this measures is how important China is for a market for Belt and Road countries, not the other way round, what we've been doing. And also, it includes all trade transactions and not just manufactures. So it's not really exactly the same question. So, what we're looking at then is how much trade do these countries do with China? Now, Western Europe isn't included in these statistics, but it doesn't really matter too much since Switzerland was only one of the countries that actually appeared in the trade cost countries. So leaving Western Europe out is not so much of a problem. But again, look at the results. Only 5 countries appear in both lists: Cambodia, the Maldives, Kyrgyzstan, Philippines, and Afghanistan. Not really offering much hope or much of an explanation. All right, one last effort. Every year, the National Reform and Development Commission that oversees the Belt and Road Initiative publishes a big data report. And that report always includes a closeness to China index, and one of its components is a sub-index of unimpeded trade or ease of trade. Remember that our data only focuses on manufactures, and this includes trades in raw materials and energy, which are vitally important for the Chinese economy. So again, I looked at our top 80 countries and I put them on a map. If you can see which countries China considered easiest to trade with in 2018. That's the last year for which I have the data. And there's again only 2 countries, the Philippines and Cambodia, that figure in both of these lists. So I'm afraid it's all a bit of a disappointment. So how do I explain this? Well, I think part of it is that much of the trade cost declines are registered with relatively smaller economies, and here chance might play a big part. A new business venture or a new rail service might have a disproportionate effect on the overall level of trade. And the second explanation is that the time period is too short. After all, we're only looking at 4 years, and we're expecting to see large-scale structural changes already occurring. They might not be visible yet. And finally, we stick with the data problems. I always say that the bias on data is not neutral. It doesn't cancel itself out. Poorer countries tend to have poorer data because they just can't afford the statistical services. So it could be that the data we're looking at will never solve the question at all. On the other hand, the period is very short. So when we get a new set of updated data, some of these trends might be clearer. So perhaps in a year's time, we'll do a second version of this. Well, I hope you haven't considered your time wasted, and that you might actually have enjoyed this podcast. The music that introduced it and leads it out is composed by Janet Zado, who is the leader of the Florence Youth Orchestra. And on the following slide, you'll find the web pages and other places on the internet where you can find us. Again, all that remains for me is to thank you very much for giving your time to listen and to hope that I meet you again online very soon. Goodbye.